Good evening, this is Nick Inman from VolumeProfileTrader.com on Saturday, March 31st, and we are officially done with the first quarter of 2012. It was a great one where the market did nothing but really rally. Any weakness was a buying opportunity, but with that said, it doesn't really matter what happened in Q1 because we have to look forward to Q2. There are a lot of money managers, hedge funds, that were not a part of this rally, or they were late to the rally. So that means either one thing to me. One is the market is, we have not seen the highs of the market for the year, which I think is likely. I assume that we'll have, worst case scenario, say we'll have one last push up, at least to test 419 or something like. Now, we're only 15 points away from that, say 1%, and that's not that big of a deal. But just saying, for example, if the run-up into the end of Q1, if that was the last gasp of the bulls, which, I mean, theoretically, it could be, you never know, the market should at least have one last test of that level, and what you would be looking for is either a successful test of that level and a print of new highs, or a lower high, or maybe a double top and a failure off of those levels. I'm going to say that I wouldn't be surprised to see 1,500 in the S&P this year, but if there's any clue as to what the market's going to do, we're probably going to top out at the, basically, before summertime approaches, sometime in May. And the only reason I say that is because that's what has happened the last 2 years since March 09 lows. And I guess, and it's a little broad to say this, but you kind of expect the expected, and what that means is you have a nice rally, and then you basically have a pretty quick and furious 20-point correction, or 20% correction, which ends up being a buying opportunity, and you look for higher prices come the end of the year, going into the next calendar year. So one thing to keep in mind, obviously still presidential year, and everything, as long as everything stays the same, you're going to have a lot of printing out of the United States, out of Europe, out of China. That's not going to change, and none of these places are going to let their economy, or I should say their markets, falter in any serious way. They're going to try to support them. So I do think you want to keep a long bias. However, with the run that we've seen, I would be more inclined to be a buyer on some pullback, maybe 5 to 10% in terms of actual selling pressure. And it's really as easy as that. And until we see some type of real selling pressure, it's going to, people are going to still be buying these mini dips. Now, I do think that this is long in the tooth and is going to end sooner rather than later. Just think of, and I'm going to zoom out just so you can see. We'll zoom out 3 years, 3 days. That's fine. What we see here is this rally back in 2010 going into 2011. The low was, call it 10,000. The high, and we're just talking about, pretty much straight rally, not this pullback and then a continuation. The high was 1344. About a 35% run up in the market. Likewise, the recent lows in last October, let's call it 1070. The high is 1419. A 33% run up in the market. One other thing just to note is, generally speaking, both of those buying opportunities, and this is the 200 period moving average on a 3-day chart, so call it a 600-day moving average, but just pointing out, the buying opportunity was when price was basically at those levels, and now we're seeing basically an excursion away from those levels. And the last time we got a big excursion away from those levels, we did revert back to this trend line. Now, if this trend line continues to gradually rise, basically you'd be looking at this 12, basically call it 1250 for an extreme pullback. But overall, we haven't even had our first major dip, and our major dips that we saw on this rally in 2010, we had a little bit of a dip. Let's see, the actual 1224 down to 1170, so about 50 S&P points, which brought you close to the middle of the channel. So a 50 S&P point drop from here would be around the 1370 level from peak to trough. So that's not a bad target to the downside. But let's get focused in what we're really trying to do, and that's manage our risk going into the second quarter. Looking at the market on these monthly charts, we're holding March's point of control, 1392-ish. As long as we hold those levels, we should be okay. What we want to see from the buyer standpoint is if price gets down to these levels, we want to see rejection from the buyers, showing you that there's enough demand down at these levels that the market wants to push back up. We saw it back in early March on the February point of control, and we had a nice bounce off those levels. And even in January's point of control, we basically went from those levels and pushed higher immediately. So just something to be aware of. And so you kind of just use those as your lines in the sand. So let's get into the names that we've held and the names that we want to continue to trade, whether it be from the long or short side. Apple, kind of predictable, but came back down to the point of control for the month of March. And what you would be looking for is a bounce off of these levels. And considering that the CEO, CFO, and a handful of senior vice presidents all took profits in their shares, I think I said this earlier this week, not a bad time to take profits yourself. American Express, as long as we hold March's point of control, I really see no bad signs in this. You can see we've just kind of been slightly trending higher, upward bias, but it's not as steep definitely not as steep as it was back at the beginning of the month. But let it do what it's going to do, and as long as we hold 57.20 or so, American Express should still be okay. Broadcom, this was a name clearly I should not have been selling. I didn't get back involved in this, but given that our cost basis is back near the 35 level, a little higher than that maybe, I don't remember exactly, I may just go out Monday and buy some. It depends. But I look at these recent lows that we've seen, call it 37.50, and I think you can keep your stop there and kind of look north from there. And this has been a bit of a lagger. Now, it had a low of 27, and now it's trading up at 39, so it's had a nice run. But if you look at the daily chart, you can see that it's been generally range-bound for the last, call it, year. We've had one deviation, or one basically big rejection below the, call it, 31 level. We tested the point of control for the year, and we've had a very nice bounce off those levels. Short-term momentum, meaning the 50-day moving average, you can see the whole moving average, which is the 144 whole moving average, both pointing straight up. So momentum's definitely to the upside. And I do think over the longer term on any weakness, you want to be a buyer of this name. You can see it's really breaking out of this consolidation, and you really don't have much volume up here after this heavy volume that we've seen. So you look for the mid 40s as far as a potential target. Las Vegas Sands still holding in there. I would just basically keep a stop under these most recent lows. At least on half of your position, whatever the case may be. This has been like a 25% winner. So it's been a very nice run. And we'd like to see this continue to the upside, but we would like to get involved at lower levels. Chevron, this is a name that I've mentioned once, and the reason why is because I think it's at a pretty good buying opportunity. I think it's a relatively low risk opportunity. You look basically at the lows that we've seen over the month of March and call it 105. Right below there you can keep your stop. So essentially you're risking about 2% for the potential upside, and although this is the current ceiling, I do think that this range that we've seen is going to break out. And if I bring up the daily chart, you can see 200-day moving average starting to move higher, which is good news. And you also see the point of control right at the 105 level, and we've been bouncing off that for the past couple days. So let me show you another example of a name that's done that and has gone on to new highs. Celgene, we were buying this back in the low 60s. 60 was the point of control for the year. You had a 200-day moving average sloping higher, and ended up being a great buying opportunity. Now it's up $20 from there. Chevron, you just have to look at it in the same way. And if you're only risking 2% for a potential of even a $10 move, it's worth it. And I do think that Chevron is a name that you can be long. Now, with that said, I have not initiated a position in this, but I will look to do so. And if I do, I will give you or send out an email. Coke, if you remember this, I talked about it last weekend, and I talked about it right against these highs, saying this looks like actually a breakout candidate, and sure enough it was, and it broke out to the upside and is up $3 or so since those levels. I have to say I'm not long Coke, but it was just an idea. I hope you caught it, and I can't say buy now because it's never right to buy a slow mover like Coke on a huge move to the upside, but nevertheless it's been a nice move. And if you caught that, maybe ring some on the register. But overall, I do not think that 74.39 is going to be the peak for Coke. American Electric, this is a name that I still think you should keep on your radar. We've been consolidating in this range for about a month now. I was telling you to buy back on this huge down day when it started to stabilize. I still think it's the right trade to be buying this. Remember, it has a 5% dividend yield, so that's pretty good news. This looks like it's going to be a nice winner, and there's no reason to shy away from this. Go ahead, step up, buy it. You can either have a stop below what looks like Thursday's intraday low, which is right below $38, and so you're risking about 2%, or you can have it below $37.50, which was the major low made looks like at the end of February. So that's your choice, but I do think this is going to be a winner. Kodiak Gas and Oil, this is a tough one. I say don't take this off your radar, but it's gotten a little volatile up here, and we're seeing three big down days. Now we have two pretty big up days. The selling volume has increased, which is something to be aware of. Maybe this is one that you want to stay away from, but I still find the name interesting. We've had a really nice base up here, and as long as we kind of hold this trend line, then I think it's okay to be long this name. If we start to break below that, say below $9.20, maybe it's time to exit the trade. Hewlett Packard, I still think this is a cheap shot, and you look at the lows that were made back at the end of last year, $21.50. Right now we're trading at $23.83, about $2 off those lows. I think that this is range bound. I do think we're going to go back up and test $28 or so in, say, in the next 6 months or so. And if that's the case, maybe this is a name that you can be long. And the reason why I think you can place your stop below these recent lows, and you'll be okay. So just something to be aware of. And your stop would be about 4%, $1 below current levels. Okay, this is a different type of trade, but it's a turnaround trade. I do think that RIM, this is crazy to say, but I do think RIM has bottomed, and I think there's an opportunity to the upside, and I think it's actually a decent move to the upside, and I think it's one that you want to be a part of. So what I'm going to do is say, go ahead and take a shot on RIM. Buy from the long side and have a stop under the lows made from earnings. So you'd have a stop around $13.30, and you would look for an upside move to around $18. But with that said, you have a point of control at $14 for RIM. My expectations are RIM is basically what you're going to have is short covering from RIM from people who've been short, and you're going to see a breakout to the upside and a push back up towards $24. If you think that can work out, which, I mean, personally I do, and I'm going to do something like this, I'm going to put on an option position that is going to give me nice leverage to the upside on RIM, and I'm going to go out a decent amount of time to give this position to work, but I don't think it'll take much time for the position to work. So I will be sending out an email to members about this trade when I put the trade on, and I really do think this is going to be one of the better trades that we're going to see in Q2, quarter two, and just a good. I think people are overlooking this, and the fact that their CEO is looking at, quote, strategic alternatives, it gives you a sense that maybe they're looking for someone to take the company over. So I look at that 24 target, and that was the September, October point of control levels. That would be my upside target. But you also have to look at this 1860 target, or 60 point of control that we saw in November, which has kind of capped any rally. That's something to note too, but I'm going to figure something out, and I think it's going to be a good one. Ford, a name that I thought was going to roll over. It still could, especially if the market rolls over. But we're still stuck in this range from $13 to $12. But one thing that I find interesting about the most recent price action is these recent lows. Has been it has been a higher low relative to the bottom of the channel. If that's the case, if we touch this top of the channel on Ford, I'd be inclined to get involved on any type of weakness with your stop basically at the lower end of this range. So let's say we start to poke our heads higher on Ford and we get any type of weakness, any type of down day, I would be looking to get involved on that weakness and placing a stop basically back below the lower half of the channel. And my expectations would be this point of control that we're seeing at $12.50 is going to hold, and we're going to see higher prices. I'm not inclined to get involved now, but give this an opportunity to do what it's going to do. I do like the fact we have a higher low from here right now, but we need to see more. This isn't done doing what it's going to do. but it could be close, and it's something worth watching. Now, probably one of my favorite positions, gold. I think that there's a good shot to the upside on this. I love point of control for the year right at these levels. I love the fact that we've really been, well, we're going to exclude this huge mess up here at the top. We've been consolidating from, say, 1800 down to, call it 1550. Now we have a potential higher low. Just like it was here, a potential higher low. But the difference between now and then, we have point of control for the year at these levels. Now what we want to see is for price action to prove us right, and we want to go see 1800 again on gold. Remember, China's not stopping the printing press. The United States is not, and Europe is not. So gold should continue to do okay. Remember, we're along the 161 by 164 call spread, April call spread on the GLD. So that gives us a little bit of immediate upside, but being long actual GLD works too. And that's what I am, and those are my only two positions in gold. Some people may want to buy, go out and buy leaps on GLD. That's fine. Whatever makes you sleep better at night. But one thing to note is that 161 by 164 call spread that we initiated in gold. When I released the email, you could actually bought it less than what I did. It probably got as low as $1, but I bought it for $1.10, and right now it's trading for $1. It closed at $1.43. $1.43 by $1.36. 46. Sorry. So the position is up, 40% or so in 2 days since we initiated the position. So still have another $1 or so left in the trade before I'd look to take it off. But GLD only has to rise another $2 on GLD, $20 on the actual gold futures. Not a big deal at all. This is the great thing about leverage, and especially with the underlines like GLD where the strikes are so close, you can really take advantage of that if you know how. So GLD looks good. Silver, it's hanging in there. Still at the value area low for the year, this blue line, which contains 70% of the volume. You have the value area high at 41.29, value area low 31.42. As long as we hold those levels, I don't think it's wrong to be short silver. I'm sorry, wrong to be long silver. But you do have a lot of shorts pressing silver to the downside. If silver catches any kind of bid, could be a nice pop to the upside. I do see that. I'm going to zoom out a little bit. You do have basically maybe this big bullish wedge forming, and you let this develop a little longer. It comes to an apex somewhere around the 30 level and then breaks out to the upside. I'm just speculating. It's nothing that I'm actually saying is going to happen. But if you look at SLV on the monthly charts, we are struggling a bit on the March profile. If we make a lower high here, we'll probably see lower prices, which means $30 or so. You'd go to January's point of control as a potential target. So we'll just have to wait and see. But let's make no doubt about it. The trend is down for now. Crude, breaking down, and you would look at your first target, 102, which is January's point of control. We're kind of finding some support there. From there, we go back down to 100. That's really it. So, if I choose to buy, actually, I do have two other names that I want to look at. One's potash, which I continue to gradually build a position in. And you can see it's just kind of consolidating up around, in the upper end of the trading channel. and what we're looking for is a break above 48. If we get that, I would look for the mid-50s, really up towards 60 as a target. Mosaic is another name. You have point of control for the year right at these lows. This is a cheap shot. You can have your stop $1 below, risking 2%. I think your immediate upside's $4 above current levels, and then from there we could press up towards 65 or 70. I think this is worth looking at, and if you want to do a call spread, you could do the 55 by 60 call spread, going out say a month, or you could do that, or you could do maybe the 60 by 65, maybe 60 by 67 half call spread on Mosaic. Just go long shares, whatever. I think the most important thing is you can have your stop right around $54, and that's basically your bogey. And if it doesn't work, it doesn't work. If it works, which I think it could and it will, that's great news. So CSX, another one that you don't want to take your eye off of, $22 to 21 has been huge high volume in this range. You kind of just want to wait for CSX. I know I've been saying buying, and I haven't. That hasn't been wrong yet. But you want to see what it's going to do from that $22 to $21 range. If you want to grow a cost basis in that price range, that's fine. But I would wait for it to break above that level to add to it. Therefore, if it drops below that level, you can easily scale out of the position for a small loss. Another name that could be a cheap shot, which I mentioned the other day, Chesapeake. I think you can have your stop below Thursday's intraday low, which was 22.50. So call it 22.49, whatever, and you can look for the upside. However, the natural gas part of that is really hurting Chesapeake and other names alike. So I just brought up the intraday chart of natural gas. This just, it really just looks ugly, and it looks like a name you want to stay away from. So that's really it. Pretty long video, but I hope it helps. Hope it gives you some ideas. We do have some news coming out of China on Sunday, which should help start the market and give us a sense of direction. I wouldn't be surprised one way or the other. But given the run that we've had in the market, I would be more surprised to see a continuation higher than to see a sell-off. So I hope that helps. Really take care. Have a good night. Have a good weekend, and I'll talk to you on Monday.